Okay. So we are looking at the overall capitalization of the company in terms of capital structure, the work. Sorry about the network interruption, network key problem. Okay, so now the type of financing, we have long-term debt of 35 million, which is about 35%, because this one coming from the total value. The preferred stock is 15 million. The common stock is 50 million, so it's 100 million. So looking at the weights here, 35 million over 100 million, which is giving us the 35%, 15 million over 100 million, which is giving us 15%, 50 million over 100 million, which is giving us 50%. So these are the weights. And then we look at the cost of debt. The cost of debt is the required rate of return on investment of lenders of a company. So when you're borrowing money from the financial institution, they will charge you a certain interest rate as a result of borrowing. So this is what goes on. So we look at the cost of debt is determined by the market interest rate, which was specified in the question. So this is after tax cost of debt. So after tax cost of debt, so we have this one, the after tax cost of debt. Okay, so on the after tax cost of debt, we are getting the KB is equal to KD. So it's equal to KD and then 1 minus the taxation. So this is on after tax cost of debt. So KB is after tax cost of debt. So we have this one as after tax. Then the other one, the KD is before tax. KD is equal to before tax cost of debt. So this is before tax. And then our T is taxation. The capital T is equal to taxation. So this is about what goes on as we are looking at this kind of equation on terms of cost of debt. So this is the one of the components as we are looking at the overall capitalization of the company. So determining the cost of debt. So we have assumed that FQM has 10,000, or let's say 1,000 quarter par value of the zero coupon bonds outstanding. Then FQM bonds are currently trading at 385.54 with the 10 years to maturity. And then the FQM tax bracket is 40%. That is on the taxation. So determining the cost of debt, we will simply have to find the coupon interest was not paid. So we have this is the amount where the bonds are trading. So the bonds are trading at 385.54, the zero coupon amount plus 1,000 over 1 plus KD. Okay, so this is the value that we have, the price of a bond. It's trading at a discount, of course. Zero coupon plus the market value is 1,000 kwacha. Then 1 is constant plus KD is what we are looking at. So we are simply saying the bond price, okay, is equal to coupon amount. So coupon amount then plus market value over 1 plus R, which is the KD to the power 10. Okay, so this is about what this one is all about. Okay, so in short, the coupon amount is 0. Okay, so we have a 0 coupon amount. So we have the cost of debt we have is equal to So here, bond price or value of a bond is equal to coupon interest. So we have the coupon interest. Then we are getting down to the market value. So this is zero coupon, they're paying zero coupon plus market value. Then on 1 plus R to the power negative N. So we can find the value of R there, which is the interest on the bond. So meaning that we have the 385 from there, we have the 385.54. So here we have the 385.54, 385.54, which is equal to zero coupon. We don't have any amount on coupon, plus the 1,000. So you have 1,000 here. Then on 1 plus R to the power negative 10. So we are simply going now to solve for R in short. So meaning that we can get the taxation there that we have is 40%. So we have to find first before tax cost of debt, and then we can find the after tax cost of debt. So from here, we need to now simply say, so we have the 1,000, then on 1 plus R to the power negative 10. And then this other side, we have the 385.54. So we need to divide by 1,000 here. And then here we divide by 1,000. So we can find the value. I'm trying to find the value of R. So 385.54 divided by 1,000. It's 0. So it will give us the 0.38554, which is equal to 1 plus R to the power negative 10. So we can sort out and find the value. Okay, so meaning that whatever we are doing here, we can just multiply by 1 over negative 10. So 1 over negative 10 by the reciprocal of this. Even this side, we can multiply by the same 1 over negative 10, so that we sort out this issue. So this negative and negative will go 10. Okay. The 10 and the 10 will go. It will be just like that. So this number to be raised to the power negative 0.1. Okay, so it will, this number is raised to the power negative 0.1. So you are going to have 1.100 is equal to 1 plus R, meaning that 1.1 minus 1 is equal to R. So 0.1 is equal to R, meaning that our 10% is equal to R. So our cost of debt is 10%. This is the before tax cost of debt, which is KD. Then we can find our KB. Our KB is actually going to be equal to KD, then in brackets 1 minus taxation. So as we find our KB KB is actually going to give us our KD is 0.1, which is the before tax cost of debt, then 1 minus the taxation is 0.4. So this is about how we find the KB, and our KB is actually going to give us the 1 minus 0.4 is 0.6 times the 0.1. So the answer will give us the 0.06. So this is after tax cost of debt. So 0.06 or 6% is after tax cost of debt. All right, so now we can get down to the other component. So this is how we calculate the cost of debt, which is the 10% here, which was found. All right, then we are getting down to 6% after tax cost of debt. The cost of preferred stock. Okay, so cost of preferred stock, we are simply saying is equal to dividend on preferred stock. So it's written as KPS, cost of preferred stock, is equal to dividend paid on preferred stock. So dividend, so it's a dividend paid. So we have this one, dividend paid, then divide by the net price of preferred stock. Net price of preferred stock. So this is about what we have, then multiplied by 100%. This is how we find the cost of preferred stock. All right, then we're getting down to the other component where we are now looking at calculating the cost of equity. Cost of equity has three major ways. So cost of equity. Okay, so on the cost of equity, we have the three ways in which we calculate the cost of equity. So in the cost of equity, we can have the first one, cost of equity is equal to risk-free, then plus beta, then return of the market, then minus the risk-free. This is one of the ways in which we find the cost of equity. Now, this is using the capital asset pricing model. So cost of equity using the capital asset pricing model. So RF is risk-free. Okay, so we have risk-free rate on the RF, and then we have the B is stock beta. This is beta, and then we have the other one, which is the RM, is the return of the market. RM is equal to return of the market, or market return in percentage form, return on the market or of the market. Then we have beta here. First of all, measures risk. The higher beta means higher risk. Then here we have the aspect where we look at the difference between RM minus RF is equal to risk premium. So this one we have the risky premium. So this is on what we have, as we are getting down to this one. Okay, now we have this cost of preferred stock, which is the required rate of return on investment of the preferred shareholders of a company who are part-time owners of a company who have no voting rights to elect board of directors at annual general meeting. So determining the cost of preferred stock, so you have to look at the dividend paid. So dividend per share that is paid, then you divide by, so assume that FQM, First Quantum Minerals, has preferred stock. outstanding with a par value of 100 kwacha, dividend per share of 6 kwacha 13 ngwe, and the current market value, market price, net price is 70 kwacha. So the cost of preferred stock is 9%. Net price is this amount. Then dividend paid is this amount. So dividend paid, dividend over price. When this is net price multiplied by 100%. So this is about how we get to the cost of preferred stock. All right, so now getting down to the cost of equity approach. So we have the one for dividend discount model. So under this one, we have the first one is we looked at the capital asset pricing model. This is the cost of equity. There are 3 ways. Then we have the other one, which is the dividend model, dividend discount model, which is the DDM. So this is the dividend. Okay, we dividend discount model. Discount model. So this is only the DDM. So under this one, we have the aspect where we find the cost of equity is equal to, okay, so we have this one, cost of equity is equal to DOO 1 plus G over PO, then plus G. This is provided that the dividend has been paid. All right, so DO is the dividend paid. So we have this one as dividend paid. Then the other one where we are looking at is G is the growth rate. So this one is the growth rate. And then our PO is actually the stock price. So PO is the stock price. So this is on what we have as we're looking at this kind of parameter. So this is when the dividend has been paid. So this is the second formula to use as we are looking at the aspect of calculating the cost of equity. The first one, capital asset pricing model. Then you are going to get to the dividend discount model when the dividend has been paid. On the third one, on the same dividend discount model, on the DDM, we have the aspect where we are looking at the cost of equity is equal to D1 over PO, then plus G. So PO is the stock price. So this is the stock price. And then D1 is the expected dividend to be paid. Okay, so we have this one, a stock price. G is the growth rate. G is the growth rate. Then D1 is the dividend expected to be paid. D1 is expected dividend to be paid. Expected dividends to be paid. So this is about what we have. Okay, so this is on the aspect of calculating the cost of equity. Now, getting down to an example here, So the cost of equity approaches, we have the dividend discount model, the capital asset pricing model, before tax, cost, and debt plus risk premium. So the cost of equity, we have here, we have this one, when for the dividend discount model, the cost of equity KE is the discount rate that equates the present value of all expected future dividends with the current market price of the stock. So we have that constant growth dividend. This is when the dividend is expected to be paid. D1 over PO plus G assumes that dividend will grow at a constant rate forever. Then the dividend, this is when the dividend is expected to be paid. When it hasn't been yet be paid, we use that other formula. Then we're getting down to assume that FQM has common stock outstanding with a current market price of 64.8. Current dividend is 3 per share and the dividend growth rate is 8%. So the dividend that has been paid there, so meaning that the current dividend that has been paid per share is 3/4. So we can now calculate the cost of equity when the dividend has been paid. All right, so meaning the growth rate is at 8%. So D1, the way we calculate the D1 is simply equal to, our D1 is equal to DO, then 1 plus G. So this is how we find the D1. So we look at the cost of equity is equal to DO is a 3. Then on 1 plus the growth rate has been given here. The growth rate is at 8%. So growth rate is at 0.08. Okay. Then you divide by PO, the stock price is at 64.8. So it's 64.8 as the stock price. Then whatever you're doing here plus the growth rate, which is 0.08. So this is on aspect where we are looking at KE. So our KE is actually going to be 3 multiplied by 1.08, then over 64.8, then plus the 0.08. So this is what we have. We multiply by 1.08, then divide by 64.8, then plus the 0.08. So our cost of equity is 0.13. So our cost of equity in this case is actually going to be equal to 0.13 or 18%. Okay. So this is about what we have as we are getting down to this problem. Then the growth phases, when the growth is in phases, okay, so we have the formulas here. They may look cumbersome, but they're straightforward because we are just trying to look at these ones based on the fact that there's a growth rate and dividend has been paid. Dividends expected to be paid using these formulas, the ones that we are using, and for the CAPM, capital asset pricing model. So we can now get down to the other way in which we can go. So capital asset pricing model, the cost of equity KE is equated to the required rate of return in market equilibrium. The risk return relationship is described by the security market line SML. So cost of equity is equal to R, which is equal to risk-free plus the return of the market minus risk-free on the beta. So we have assumed that FQM has a current beta 1.25. The risk-free is at the beta is equal to 1.25. Then we have the risk-free of 4%. And then we have the return of the market of 11.4%. So which is about what goes on as we are looking at this kind of equation. So we can now say our CAPM, cost of equity, is equal to our risk-free, then plus beta, then we have the return of the market minus risk-free. Okay, our cost of equity now in this case is going to be our risk-free rate of interest is equal to 11.4%, or you can put it in percentages, plus the beta. It has been given as 1.25. Then the return of the market is, okay, the risk-free of rate interest is 4% from the question. So it's 4% plus the beta is 1.25. Then on the return of the market is 11.4. And then the risk-free rate of interest is 4. So our cost of equity is actually going to give us the difference between, so we say 11.4 minus 4 multiplied by 1.25 and plus 4, which is giving us 13.25%. This is our cost of equity. 13.25 is our cost of equity. All right, now from here we can now getting down to the other examples. As we look at now the overall capitalization of the company. So that is our cost of equity there. Before tax cost of debt plus risk premium. Okay. So that means the cost of equity as a number of ways. Okay. So we have the aspect of those three formulas. So we have the cost, for the constant growth model, the cost of equity is at 13%. And then capital asset pricing model is at 13.25%. Then cost of debt plus risk premium. The cost of debt here is, we found the cost of debt was 10%, which was calculated. The cost of debt was calculated as 10% using this kind of equation from where we are coming from. So the cost of debt was calculated using this. Coupon interest was 0 coupon. So it was 0 coupon interest plus this one. From there, we found the cost of debt was 10%. All right. And then the cost of equity, we have found various costs. We have the 13% cost of equity. And then we have the other cost of equity using this was using the dividend discount model. The cost of equity was 13.25 using the capital asset pricing model. So we have supposed to look at the cost of equity that is cheaper among those costs. Then getting down to the cost of the before tax cost of debt. Okay, so you have before tax cost of debt plus risk premium. So cost of equity capital is the sum of the before tax cost of debt and the risk premium for the common stock over the debt, cost of debt plus the risk premium. So risk premium, we know it is okay. So typically adds the 2.5, assume that this FM typically adds the 2.75 premium to the before tax cost of debt. They are just assuming that. So meaning that this is the cost of debt plus the premium. It is cost of equity is 2.75. So we compare which one is cheaper. So the cost of equity plus risk premium seems to be the cheapest mode. So generally the three models will not agree. We must decide how to weigh how we use the average of these three. So the cost of retained earnings, retained earnings equally belong to the shareholders and are supposed to be paid as dividends. they form part of the internal equity of the company. When we talk about internal equity of the company, this is the equity that is raised simply by plowing back the company's profit. We have two types of equity where we talk about internal and external equity. So internal and external equity. Okay, so under these two, we have our internal equity. We are simply saying is the equity raised simply by so under internal equity, we are simply saying this is the equity raised by simply plowing back the company's profit. So equity raised by plowing back, okay, by plowing back the company's profit. So plowing back profit is what we call internal equity. Okay. E.g., we have retained earnings. Retained earnings is part of internal equity. Okay. Retained earnings. This is just about the equity that we have retained into the business. Okay, on the first aspect. And then also we can talk about reserves. Reserves are also part of internal equity. Then we have our external equity. We are talking about the equity raised by selling share to the general public. So we have external equity. It's the equity raised by selling shares to the general public. So under this external equity, we have common stock. So our common stock is a part of external equity. Okay, so this is about what we have here on it. So we sell, say equity raised by selling shares, equity raised by selling shares to the public. Equity raised by selling shares to the general public. Okay, so we have these two types of equity that we are looking at. Then we getting down to the other aspect where we now look at the overall calculating the weighted average cost of capital for the company. Weighted average cost of capital work is the average rate of return that the company expects to compensate or is different investors. When a company with a given target capital structure uses different forms of capital in its capital structure, an average cost of the capital will be computed. Okay, so now here we have weighted average cost of capital work when we have the three components in the capital structure. We have the cost of debt in the cost of preferred stock, or the cost of the three should sum up. Okay, so we have the component of debt is at 35%. So debt is at 35%. Taxation was at 40%. Okay, then we have the cost from the information given here. We have the target with the capital structure from here, where we are looking at the aspect of debt, equity, and preferred stock. These are where the figures are coming. So debt is at 35%, preferred stock is at 15%, and then common stock or equity is at 50%, which we gave us 100%. From here, we know that we looking at the overall capitalization of the company, and then the other things have already been computed. So we are supposed to use the cheapest mode of finance. So on our work here, we are going to use the 13%. Okay, the 13% is what we are going to use when calculating the cost of equity using the dividend discount model, the 13%. Okay, this is almost the same as this. When you round off, it will be 13, or even this one, 13%. The average of those 13 plus 13.25 plus 12.75, the total, then divide by 3 is 13%. So we are finding the average of these three. That is where the 13 is coming from. So average of those 13, 13.25, 12.75. So this is how we're going to find the cost of equity, because we have found three different answers on that. So we need to find the average. So on the cost of equity, from there, our cost of equity is actually going to be 13%, then plus the other one is 13.25. So after 13.25 there, then also we have plus 13, that is 12.75. So, and then we divide this by 3. Our cost of equity is actually going to be 39. Then divide by 3, where our cost of equity now is going to give us 13%. So this is on how we are getting to calculating the cost of equity. All right, so now the work here will be our weighted average cost of capital is equal to weight of equity multiplied by cost of equity, then plus weight of preferred stock multiplied by the cost of preferred stock. There are three components there, then plus weight of debt, then multiplied by cost of debt, then 1 minus the taxation. This is the formula to use as we are looking at the overall capitalization of the company. So our work here is actually going to give us the weight of equity is at 50%, which is 0.5, multiplied by the cost of equity is at 0.13, the average we are from finding, then plus the weight of preferred stock was 0.15, then multiplied by the cost of preferred stock was 0.10, which has already been calculated, then plus the weight of debt is 0.15, then multiplied by cost of debt, which is 0.1, then multiplied by 1 minus the 0.4. Okay, so meaning that our work, the 0.4 is a taxation, which has been given in the question already. So from there, we can go one by one, 0.5 multiplied by 0.13. So I see 0.065. Then plus the other one is 0.15 by 0.1. So 0.015, 0.015. Then plus the other one is 0.15 by 0.1 by 0.6, so 0.09, so 0.009. Okay, so this is about what is going on as we are looking at the work. So our work is actually going to give us the 0.065 plus the 0.015 plus the 0.009. So it's giving us the 0.089 as our overall capitalization of the company. We're looking at the capital structure of the business. So this is all, can multiply this by 100, giving us 8.9%, which is approximately 9%. This is on now this weighted average cost of capital, the answer that you have gotten. So this one looks at the overall capitalization of the company in terms of equity, in terms of the preferred stock, in terms of debt, and in terms of the equity component. Okay, so meaning that the 0.35 was the cost of debt from there. So we just have to look at the cost of debt. What was our cost of debt? Our cost of debt was, okay, so getting down to this, we have the cost of debt. Okay, so the debt was 35%. So debt, we have 35%. The preferred stock, we have 15%. And then we have the equity of 50%. So it's just substituting in the formula here. We are getting the values of 9.9, which is approximately 10%. So this is it. The work in this case will be the 35% on the 6%, which is this 0.35 multiplied by, before tax cost of debt was 10, and then multiplied by 1 minus the taxation or 0.4. So this is about where the 6% came from. And then the 0.15 was on the preferred stock. And then the cost of preferred stock, so it was given here, it has been given as 9%. So using this figure, 9% has been given. And then the cost of equity is 13%. And the weight of equity is 50%. So aggregating these to find the weighted average cost of capital, we are just looking at the sum of those 0.021 plus the 0.0135 plus the 0.065, which is giving us 9.9 or approximately 10%, which is the weighted average cost of capital. So this is very, very important because we use it in capital budgeting. You cannot compute the NPV and you cannot compute the profitability index in capital budgeting. We cannot even compute the internal rate of return if the cost of capital we are not given. All right, so this is the significance of this weighted average cost of capital. So we are looking at advantages of a work, which is the weighted average cost of capital in project evaluation. It is simplicity, and then the same rate can be used for all the projects. And then the limitations, it may be affected when the interest rate in terms of debt changes. Okay, so it's based on an impractical assumption of the same capital mix of for the capital structure, which is very difficult to maintain. Okay, and then does not take into consideration the flotation cost, meaning that when anything else changes of the raising the marginal capital for the new projects. And these, what are these flotation costs? These are costs associated with the issuing securities such as underwriting, the legal, the listing and printing fees. So, and then other other flotation costs depend on the firm's risk and the type of capital being raised. So this is about what goes on. So in conclusion, the weighted average cost of capital looks at the cost of raising funds in terms of debt, in terms of equity, and in terms of preferred stock. So In short, it looks at the overall capitalization of the company in terms of the company, how is the company raised finance. So the company can raise finance by issue of shares, that is internal. We can look at equity. The issue of shares is equity component. Then also the company can resort to borrowing where they have debt. Okay, so this is the company will be geared. And then we have the other component, they can raise finance by issue of preferred stock. So these are the three components of the capital structure. So sometimes the preferred stock may not be there. So meaning that the work will only have two components, that is equity and debt. Okay, so the preferred stock may not be there sometimes. So we're going to have just equity and debt, meaning that the formula for this one will just involve the equity component, where we are looking at the weight of equity, then multiplied by the cost of equity. And then the other aspect for debt will be KD, which is before tax cost of debt, then multiplied by, here we are going to have 1 minus taxation. And then we talk about the weight of debt. So in short, this one will be weight of debt multiplied by cost of debt, then 1 minus the taxation. So this is it on the aspect where we have only two components in terms of debt and equity and calculating the weighted average cost of capital. So this is what this topic is all about. Very, very important topic in corporate finance. So we can end the class for now.